If you started investing today with $1,000, there's a good chance you'd lose money before you ever made any. Not because the market crashed, not because you picked a bad stock, but because of one mistake almost every new investor is making right now, and nobody's talking about it. Today we're talking about something that's quietly wrecking portfolios all over the world, and most people don't even realize it's happening to them. We're not talking about inflation. We're not talking about interest rates. We're talking about the biggest problem with investing right now, and by the end of this video, you'll know exactly how to spot it in your own strategy before it costs you real money. Let's get into it. Look, everything I just shared with you is only the beginning. The real strategies, the exact steps to fix this problem in your own portfolio, that's coming up in the next few minutes, so don't go anywhere. And if you're serious about actually growing your money, instead of guessing your way through it, hit that subscribe button right now, because every single week I break down exactly what's happening in the markets and what you should be doing about it. Let's keep going. Let's talk about the first big problem, and honestly, this one might be the sneakiest of them all. Information overload. Here's what I mean. 20 years ago, if you wanted to learn about investing, you had maybe a handful of books, a financial advisor, and the evening news. That was it. Today you wake up, open your phone, and within 5 minutes you've seen 3 different people telling you 3 completely different things. One person says buy this stock because it's about to explode. Another says the market is crashing next month, sell everything. A third one is telling you gold is the only safe place for your money right now. And you're sitting there thinking, okay, who do I actually listen to? This is the trap. It's not that people don't have access to information anymore, it's that they have too much of it, coming from too many directions all at once. And when your brain gets hit with that much conflicting noise, something interesting happens. Instead of making a decision, you freeze. Psychologists call this analysis paralysis, but you don't need the fancy term to understand it. Think about the last time you tried to pick a show to watch, and there were literally thousands of options. You scrolled for 20 minutes and ended up watching nothing. Investing is doing the exact same thing to people, except instead of wasting 20 minutes, they're wasting years of potential growth sitting on the sidelines, too overwhelmed to start. And it's not just the freezing that hurts you. The other side of information overload is even more dangerous. It's impulsive action. Someone sees a video with 1,000 comments hyping up a stock, and instead of doing their own homework, they jump in with real money because the fear of missing out feels stronger than the fear of losing. Then, 2 weeks later, a different creator says that same stock is a disaster, and they panic sell at a loss. That's not investing, that's emotional whiplash, and it's happening to thousands of people every single day. So what's the practical fix here? It starts with narrowing your sources. You don't need 50 opinions, you need 2 or 3 trusted, consistent sources that actually explain their reasoning instead of just shouting predictions. And before you act on any piece of financial advice, ask yourself one simple question: do I actually understand why I'm doing this, or am I just reacting to noise? If you can't explain your own reasoning in 1 or 2 sentences, that's usually a sign you're not ready to put your money in yet. Think of it like this. A smart investor isn't the person who consumes the most information, it's the person who knows how to filter it. That's the real skill nobody's teaching you, and once you master it, the rest of your investing journey gets a whole lot clearer. Now let's move to the second problem, and this one's tricky because it doesn't feel like a problem at first. It actually feels exciting. Everyone wants shortcuts instead of strategy. Here's the thing about human nature, we're wired to want results fast. Nobody dreams about slowly building wealth over 20 years. We dream about the stock that 10x in a month, the crypto coin that turns $500 into $50,000 overnight, the one trade that changes everything. And look, those stories do exist. That's exactly why they spread so fast. But here's what nobody shows you. For every one person who got lucky on a shortcut, there are hundreds of people who lost real money chasing that same dream. Let me give you a simple example. Imagine 2 people start investing on the same day with the same amount of money, let's say $2,000 each. Person 1 hears about a hot stock that's trending everywhere, throws all $2,000 into it hoping to double their money in a month. Person 2 takes that same $2,000, puts it into a solid, diversified investment, and just leaves it alone, adding a little more every month. Fast forward 5 years. Person 1 has probably jumped from trend to trend, some wins, some big losses, and honestly, Most of the time they end up right back where they started or worse. Person 2, doing the boring thing, consistently investing without chasing hype, has actually built real steady growth. Same starting point, completely different outcome, and the only difference is one of them wanted a shortcut and the other one trusted the process. This obsession with quick wins isn't just a money problem, it's a mindset problem. We've been trained by social media to expect instant results in everything, instant followers, instant fame, instant success, so of course we bring that same expectation into our finances. But money doesn't work like a viral video. Wealth is built slowly, quietly, and consistently, and that's honestly the least exciting sentence you'll hear all day, but it's the truest one. So what should you actually do instead of chasing shortcuts? Shift your focus from what's trending to what's proven. Ask yourself, is this decision based on hype, or is it based on a strategy I actually understand and believe in for the next 5, 10, even 20 years? If your only reason for investing in something is because everyone's talking about it right now, that's a red flag, not a green light. Here's the mindset shift that changes everything. Stop asking how can I get rich fast, and start asking how can I get rich for sure. Slower, yes, but sure. Because in investing, boring and consistent almost always beats exciting and risky, even though nobody wants to admit that when they're scrolling through their feed at midnight. Now on to problem number 3, and this one hits close to home for almost everyone watching, because we've all done this at least once. Social media is replacing real research. Think about how most people discover an investment idea today. They're scrolling, maybe on a break, maybe right before bed, and a video pops up. Someone confident, good lighting, talking fast, telling them this one stock is about to blow up. It's 15 seconds long, maybe 30 if they're being generous, and by the time that video ends, thousands of people have already opened their trading app to buy in. No research, no reading the company's earnings report, no understanding what the business actually does, just pure trust in a stranger on the internet who seemed really sure of themselves. Here's what makes this so dangerous. Confidence on camera has nothing to do with accuracy. Someone can say a stock is going to triple in value with total certainty in their voice, and be completely wrong. But because it's delivered with energy, music, and fast cuts, our brain treats it like solid proof instead of just one person's opinion. That's the trick. It's not that people are lazy or careless, it's that short-form content is designed to feel trustworthy even when there's zero substance behind it. Let me paint a real picture of how this plays out. Someone puts $2,000 into a stock because of a video they saw during their lunch break. They don't know what the company actually sells, they don't know if it's profitable, they don't know if it has debt problems. 3 weeks later the price drops 30% because of news they never saw coming, and now they're panicking, asking in comment sections what happened, when the real answer is simple: they never actually understood what they bought in the first place. So here's the practical fix, and it's easier than people think. Before you put a single dollar into anything you saw online, spend just 10 minutes doing basic research. What does this company actually do? Is it making money or losing money? Why did the person in the video recommend it? Did they explain real reasons, or did they just say trust me? If a video can't give you a clear, logical reason beyond hype and excitement, that's your sign to slow down, not speed up. Think of social media as the spark that gives you an idea, not the source that gives you the answer. It's totally fine to discover a stock or an investment idea from a video. That's actually how a lot of people get started, and that's okay. The mistake isn't watching the video, the mistake is stopping there. The moment you treat a 15-second clip as your entire financial strategy, you're not investing anymore, you're gambling with extra steps. And the good news is, once you build the habit of doing that quick 10-minute check, you'll start separating real opportunities from noise almost instantly. Let's get into problem number 4, and this one might be the most emotional trap of them all. Fear of missing out is driving bad timing. You know that feeling? You're scrolling, and you see a stock has jumped 40% in a week. Everyone's posting screenshots of their gains. The comments are full of people saying they wish they bought in earlier. And something in your chest tightens a little. That little voice says, I need to get in now before it's too late. That feeling right there, that's FOMO, and it has probably cost investors more money than almost anything else on this list. Here's the problem with buying because of FOMO: by the time you're hearing about it, seeing the hype everywhere, watching everyone celebrate their gains, the easy money has usually already been made. You're not getting in early, you're getting in late, right at the moment when prices are at their highest and excitement is at its peak. And what happens next? More often than not, is the price starts to cool off, sometimes it drops hard. And now the same people who were celebrating are suddenly panicking. And guess what they do? They sell. They sell at a loss out of fear, the same emotion that got them and also gets them out. Except now they've lost money instead of making it. Let me give you a simple example. Imagine a stock trading around $50 a share for months. Nobody's talking about it. Then suddenly it jumps to $80 in a week because of some viral news. And it's everywhere online. Someone jumps in at $80 because they're afraid of missing the next big thing. 2 weeks later the hype dies down, the price drops back to $55. Now that person is sitting on a loss, feeling burned, when the people who actually made money were the ones who got in months earlier, quietly, before anyone was talking about it. This is exactly why buying high and selling low keeps happening to so many people. It's not because they're bad at math, it's because emotions move faster than logic. Fear of missing out pulls you in at the worst possible time, and plain fear pushes you out at the worst possible time too. So how do you actually protect yourself from this? First, if something is trending everywhere and everyone's talking about it, that's usually your cue to research carefully, not to rush in blindly. Second, ask yourself, would I still want to invest in this if nobody was talking about it right now? If the honest answer is no, that's FOMO talking, not strategy. And third, have a plan before you invest, not after. Decide your entry point and your exit point while you're calm, not while your emotions are running the show. The investors who win long-term aren't the ones who never feel FOMO. They're the ones who've trained themselves to pause, breathe, and think clearly before that feeling makes the decision for them. Now let's talk about problem number 5, and honestly, this is the one that scares me the most, because it's silent until it isn't. Nobody is talking about risk anymore. Think about the conversations happening online right now. Everyone's talking about gains, everyone's talking about the next big opportunity, everyone's celebrating how much money they made this month. What you almost never see is someone calmly explaining how much they could lose, and why that matters just as much as how much they could win. When the market has been feeling strong for a while, risk starts to feel like an old-fashioned idea. Something your grandparents used to worry about, not something that applies to you anymore. And that mindset right there is exactly how people get blindsided. Here's a simple way to think about it. Imagine 2 people driving the same road every single day for a year, and nothing bad ever happens. One of them still wears their seatbelt every time, out of habit, out of respect for the fact that anything can happen. The other one stops wearing it because, hey, nothing's gone wrong so far, why bother? Then one day, something unexpected happens, a sudden stop, another car, anything. The person without the seatbelt is the one who gets seriously hurt. Investing without thinking about risk is exactly like that. The market can feel calm and rewarding for months, sometimes even years, and that calm is precisely what convinces people to drop their guard. Let's put this in real numbers. Imagine someone puts their entire $10,000 into a single stock because it's been rising steadily and everyone's confident about it. No backup plan, no diversification, all the eggs in one basket. Then unexpected news hits, maybe a scandal, a bad earnings report, a shift in the industry, and that stock drops 40% in a matter of days. That's $4,000 gone, not because the market crashed everywhere, but because this one person had zero protection built into their strategy. Now compare that to someone who spread that same $10,000 across several different investments. Even if one of them drops 40%, the overall damage is much smaller because they built in protection before they needed it. That's really what risk management is. It's not about being scared of the market. It's about being prepared for the version of the market that isn't always kind. It means not putting everything into one investment, no matter how confident you feel. It means asking yourself before every investment, not just what could I gain here, but what am I actually willing to lose if this goes wrong? It means having some money set aside that you're not touching no matter what happens in the market that week. Risk isn't the enemy of good investing, ignoring it is. The investors who last for decades aren't the ones who avoided risk completely. They're the ones who respected it enough to prepare for it long before they ever needed to. And now we land on problem number 6, and honestly, this might be the root cause behind every single problem we've talked about so far. Most investors don't have a real plan. Think about it for a second. If you were going to drive across the country to a city you've never been to, Would you just get in the car and start driving with no map, no directions, no idea where you're actually headed, just vibes and hoping you end up somewhere good? Of course not. That sounds ridiculous when we say it about a road trip, but that's exactly what most people are doing with their money. They're investing without a destination, without a timeline, without any real idea of what they're trying to achieve, and then they wonder why they feel lost, stressed, or stuck every time the market moves. Here's what a real plan actually looks like, and it's simpler than people think. It starts with a goal, not a vague one like I want to be rich, but a specific one. Like I want to have $50,000 saved in 5 years for a down payment, or I want to have enough invested by the time I'm 60 to retire comfortably. Once you have that goal, you need a timeline, because how you invest for something 5 years away looks completely different from how you invest for something 30 years away. And finally, you need an exit strategy, meaning you actually decide ahead of time. Under what conditions would I sell this? What would make me change course, instead of figuring that out in a panic when the market drops 10%? Let me show you why this matters with a quick comparison. Imagine two people, both investing $200 a month. Person 1 has no plan, they're just putting money in because they heard it's a good idea, and the moment the market dips, they panic and pull everything out, losing momentum and often locking in losses. Person 2 has a clear plan, they know they're investing for retirement 15 years from now. They know market dips are normal and temporary, so when the price drops, they stay calm. Sometimes they even invest more, because they understand it's part of the long-term picture. Same monthly amount, same market conditions, completely different results, because one of them has a plan and the other one is just reacting. This is honestly the fix that ties everything else together. All those earlier problems, the information overload, the chasing shortcuts, the FOMO, the ignoring risk, they all get so much smaller once you have a real plan, because a plan gives you something to come back to when emotions try to take over. So before you invest another dollar, sit down and actually write out your goal, your timeline, and your exit strategy. It doesn't have to be complicated, it just has to be yours. And once you have it, you'll realize just how much clearer and calmer investing becomes. And listen, here's the truth. The biggest problem with investing right now isn't the market, it's not the economy, it's the way people are approaching it. And now that you know exactly what to avoid, you have an advantage most people never get. So take this seriously, apply it, and start building the kind of wealth that actually lasts. I'll see you in the next one.